Okay, welcome back for another weekly training session, folks. We're going to get right into it. We're going to do a whole bunch of good stuff today. As I mentioned in the intro, we're going to go over a bunch of gold and silver stuff. I've got some things I'm going to show you there and what I might be planning to invest in. And we're going to go over all the usual news and everything and do a bunch of more game planning, battle training, and jump right into the 1970s charts and check out what did it look like when we had stagflation. And we're going to listen to Ray Dalio a little bit about stagflation later as well. So let's go get started here. We'll share the screen. Okay, so we're gonna go over some updates and we're going to kind of do our usual little roundup here at the beginning. And then we're gonna get going into the regular chart analysis. So let's go here. So with some of the headlines here, let me just double check something here. I'm not sure you're getting the shared screen yet. Let's do it again here. Okay, there you go. Now you should be able to see my screen. Okay, so what happened since we last met, right? It's all been talk about inflation and rate hikes and recession, no recession, soft landing, hard landing. It's all this stuff now. So this week we had some more bad news. Okay, so I've been kind of warning to stay vigilant and stay patient. And you'll see that the Eurozone inflation hit a record of 8.6%. That's the same as the US just had last month. And the European Central Bank is preparing for its first rate hike in 11 years, folks. That's not a typo. That's the first rate hike in 11 years. Now, remember, the European economy has been on shaky grounds for a long time. And you'll remember that in 2011, I always remind you guys of this. In 2011, the US credit rating was downgraded in August. And in September, Europe said that Greece might fail and go bankrupt. And so that was 11 years ago. So, I mean, they haven't bothered to hike rates since Portugal and Italy and all these different countries have been struggling, while Germany and a couple others are doing good. So the inflation's at a record high. If they start raising rates, I mean, my family in Italy and all kinds of different other people in other countries there, they're not going to be doing too well. It's already been bad for over a decade. So that's not a good thing, folks. And, we'll have to really watch carefully what's going on there. They're doing the rate hikes, though. I mean, that is coming because they can't let inflation stay at 8.6%. Although people can't stand the rate hikes, they can't stand the inflation even more, right? If your bread goes from $1 to $1.08 and $1.16, if that keeps happening, and I think it's going up way more than that anyways. So let's keep looking at the news here. So the S&P posts the worst first half since 1970. And, that one's not a good statistic here. Let me just double check the chat here. Okay. So, worst first half since 1970. If you listen to Ray Dalio and other economists here, basically 1970 is when we began stagflation and we had peak inflation and they started to raise interest rates. And that's why I keep reminding you of that. So notice how the stuff I've been teaching you about, we've been talking about, and Ray Dalio has been talking about and others, it's coming up in the headlines now. The worst first half since 1970. I always correlate this news to the stagflation and to the 1960s, peaking of inflation. And when we had record high inflation, the highest since 1980, 82, that's another time where we had crazy inflation peak again. And that's why it's stagflation. We're going to have rate hikes while inflation is still going on. So the NASDAQ and the S&P started falling. Let's go check those out. Okay, so we've been doing this over and over again here. Let's go check in and see what the S&P has been doing. It's actually, what happened was it started the week following and it actually ended up not so bad. So let's go check it out here, the SPX. Okay, so, this past week wasn't so bad and we were falling prior to that. So let's get the 1 day. There we go. So right at the end of the week, we had a little bit of a rally here. So let's zoom back out again. That was a 1 hour chart, folks. Okay, so the daily chart now, and you'll see the big drop on your screen there. Let's go focus in on the big dropping area now. And essentially, I want to just draw it out for you. So remember, we've been talking about how it's doing this, and then it went lower, right? Lower. Now it's went up, it's coming down again. Who knows what it's going to do? It could still go lower. There's no reason to think that we're necessarily out of the woods yet. So I would be really careful. Now, how do you know when you might want to get a little bit more excited? What I would say as a general rule of thumb is this. So when this fell and it pumped up here, and then it came down a little bit, what you'd want to see is, are we going to go back above that resistance again? And that might make you think that we're going higher. And if you want to see why I think that, let's look over here. I made a little high, we broke out of it, and we went through it, right? You could have tried to take, hold on to a position a little longer, maybe add to it, and then take your quick profits as we approach the next resistance up here, right? So, and why a quick profit? Because we're in the middle of a recession, probably, right? So it's not a good time to just hang on to your stocks like a year ago or 2 years ago, where I was just saying, hang on to Nike, it just touched the 200-day moving average, hang on to Microsoft. It's different now. It's like, do you want to trade the S&P? So if you've been doing that and you use that kind of a rule basis, I think you can do a pretty good job of it. So here right now, let's look at it here. It's going up, it came down. If it goes above that area there, folks, you might be able to catch a rally into this zone over here. Okay, so maybe around 4,100, you cash out on your trade. Okay, if you're doing the SPX or your triple Qs or whatever you're doing there. So if you're trying to figure this out right now, it's a little bit tricky. You have to catch a moment like that in order to catch a trade. So is that going to happen again here? And is it worth catching a little short move like that? That's up to you. I mean, I recommended that if you were going to nibble on stuff, you should nibble on good stuff. So if you pick something like Apple, that's where a lot of the volume is going to go, right? So if you were someone who's been nibbling on Apple throughout this area here, right, as it's kind of making different series of lows here, if you believe in it enough that you grab a little, and if it drops, you'll hold those long term and cost average by buying more cheaper, then basically whenever it moves somewhere into this zone right here, if you got in at 130 to 135 range, you can get out at 145 or 150 range. Okay, now it might not sound like a home run, and you don't have to sell it all in one shot if you don't want to, but I guess what I'm saying is, what if you were buying over here? Okay, what if you were buying in this zone over here? Kind of, so here's zone number one, here's zone number two. Okay, so what if you bought in zone number one and you were checking to see if it was going to go above this area? Well, I would say that you need to cash out if you're bearish, because it dropped a lot more after that. So do you want to get out again over here the way that maybe you should have back here, right? That's the way I'm looking at it. And I'm treating this as something to make a short trade or do nothing, hold cash. Maybe you think I'm too bearish and you don't agree with me. If that's the case, you have to figure that out for yourself. But for me, if I'm zooming out here, let me take off the drawing tool. Okay, so why is Mike so bearish? Let's go here. So the move since the beginning of COVID over there, let's go see the Fibonacci retracement again over here. Okay, so let's bring it down over here, lock it in, drag it to the top. Okay, and then touch the white space to lock it in. So when you're looking at it over here, I feel as though maybe the correction or the bottom is in, so to speak, but maybe it's not. When are they going to admit we're in a recession? We're going to go through some more news and show you how, depending on who you're asking, they already feel we're in a recession. So, are we going to get a bounce up and then hit these other, let's go here. Here's the 50% retracement. Here's the 61.8% retracement. Right now, we're trying to hold that 38.2% retracement right over here. So, what are we going to do? Are we going to end up holding, or are we going to go down to the next level here or the next level here? I think we're going to get a bounce soon. Maybe we'll touch the 50 first and then bounce. Inflation will start to go down. The rate hikes will start to work. And maybe we'll get a bounce, but I think what's going to happen still is in the fall or the winter, we're going to go down and probably go towards that 61.8% Fibonacci retracement level, which although might sound crazy, guys, it's only bringing us back to the lows of the election of 2020. It's not even bringing us back to the COVID lows way back here. That's COVID over here. Okay. This is just the election lows. Okay. So can we go back to the election lows and simply do kind of like a staircase pattern like that? I think that's super likely. I can't guarantee you anything, right? So I don't recommend that you be all cash necessarily. You can diversify a bit and have some good stocks you're hanging on to. You can do whatever you want in terms of your mixture. But that's my view on it. I think the landing zone will be somewhere in this zone here. Okay, this kind of darker green zone there. So for the Apple chart, I'm looking at 100 to 120 range. We're sitting at 138. Can't guarantee you it's going to happen, folks. But I mean, as we go through the rest of the lesson today, and if you've been watching and you keep watching, I'm not trying to wish for it to happen. I'm not trying to make things up. It seems like that's the direction we're going. And it seems like that's probably going to be the area we land in. So let's check it out and keep going with the news here. Okay. So we have the Federal Reserve, the Atlanta Federal Reserve tracker shows the U.S. economy likely is already in a recession. We already had a drop of 1.5% in the GDP in the previous quarter. I think it was the first quarter of the year. In late July, they're going to announce the second quarter GDP and what that did. And right now it's tracking for negative, right here, look at it, folks, negative 2.1%. So, negative 1.5%, negative 2.1%. We're going to be at a point where we have two drops in a row of quarterly GDP, and the overall GDP might be close to nothing in general. So this is not very good. The first quarter declined at 1.6%. I've been saying 1.5%. Looks like it's saying 1.6%. So, if you're looking at it from that perspective here, folks, you'll see right on the screen there, 1.6%. And we have a projection of potentially 2.1% coming. So if you're looking at that, that's the definition of a recession, right? That's the definition of a recession. Let's listen to this video here. We're going to go through a couple different things and listen to some conversation. Now, not every expert's always correct, and everyone will have their different views of this gentleman and the other ones, but just look at how everything's lining up. And they're not talking about a continuous nonstop recession that keeps going week by week forever right now. Maybe we'll get a bounce and we'll get the recession later this year or into next year. But let's listen to this conversation here. It's a good one.
Mohammed, here's my probably biggest question about the overall economy as we head into the second half. It looks like consumers are still spending, but they've been spending down their savings. Inflation remains stubbornly high. The essentials cost more, and the cost of borrowing is certain to rise. So is there the risk of this consumer vice where consumers could slam the brakes more quickly than historically?
Thanks, John, for having me. Yes, absolutely, there's the risk. We left out three additional things. The Fed is hiking aggressively into a slowing economy. The fiscal impetus is now negative, and exports aren't doing too well. So you have these various components all coming together and slowing our economy much faster than we'd like it.
Does the Fed have any choice, though?
No, it doesn't. It was late, and it fell into the worst trap, which is you have to play catch up, but your window for hiking rates in an orderly fashion has closed. So rather than helping the economy soft land, the Fed now risks actually contributing to a hard landing, and that's of its own making. Because
okay, so I wanted to make sure I played that again, not to be doom and gloom, but I kind of agree with what he's saying. And, everyone's going to have their own different opinions on this stuff. Me personally, I've been seeing this coming. I've been warning you guys to go towards cash for quite a while now, since the beginning of the year, January, February, before Putin started the war. Everyone's blaming Vladimir Putin still. Every week I hear different governments in Europe and Canada, everyone's just blaming Putin. The inflation was at a record high, like at Christmas. I mean, it's not, Putin is not making it better. But that's not what happened. If you need to lose a couple 100 pounds, I don't think it's the current cheeseburger that's really causing the problem. It's what you've done before that. And the inflation problem has been building for a while, and it got huge, and then Putin came. So, I think right now we're in a period where the Federal Reserve printed too much money. They did need to print some money, but they created one of the biggest, sharpest bull rallies of our lifetime, when they could have created a gradual rally that was more sustainable without having a huge recession now and having to hike rates so much. So I just think it's, putting the kid in a candy store and letting them eat all the candy, and then you make them eat broccoli and drink water all of a sudden, and they're going to hate you, and it's going to be rough. And that's kind of what we're doing, right? Everyone's lending and giving people cheap money for years. The pandemic comes, it's even more, it's even worse. And now all of a sudden, let's hike the rates. You get no money, figure it out. That's basically what we're doing right now. It's a horrible way to run the economy, but I'm not surprised, because if you study economic cycles and you study Ray Dalio and you study all these people, you hear Alessio Rostani, you hear this gentleman we just listened to there, they're all of the same mindset of me and all these other economists, because they've studied past market cycles. So let's go jump right back in here. Okay, so you got people saying basically we're already in a recession. Remember, the Federal Reserve, there's different sections of the Federal Reserve. The Atlanta Fed said we're likely already in a recession. Kathy Wood said it. Lots of people have been saying it. But when you get a politician on stage, or Jerome Powell, and their job depends on it, they're going to say, no, we're all good. We're going to do a soft landing. We've got this under control. And then just like October 2008, all of a sudden, oh, hey, by the way, yeah, we got it wrong. It's a recession. Never could have seen it coming. So that's what I think they're doing. So Powell's vowing to prevent inflation from taking hold in the US for the long run. Keep in mind, when he says this, what that means is, look at what he's saying. Okay. He's saying that he's going to prevent inflation from taking hold in the US for the long run. How can inflation be brought down? They only have one way to do it: raise rates. So if they keep raising rates, we're going to have ourselves a big recession. So I think it's all talk. I think it's like someone that needs to lose a few 100 pounds saying, I'm going to go to the gym every day and I'm going to start on day one and go for 2-3 hours a day. You're not going to make it. You got to figure it out in a more sustainable fashion. And that's why we're calling for stagflation, because you can't go that hard, that fast all at once. And that's why Mohammed there was talking about, the Federal Reserve is creating a hard landing, and they're pretending we're going in for a soft landing. That's what I think is happening. They're going to raise the rates and crush the economy, which will bring down inflation faster. I think that's what they want. So let's go check out this one here now. This is a discussion. Now they're going to market plant-based meat here for us. So, when we're looking at this stuff here, this is another conversation here with Ray Dalio, and we're going to listen to this here. I love listening to Ray Dalio. Just give me 1 second here, folks. I'm just going to pause it here and make sure I'm sharing the screen properly. Okay, so we're going to go over this video here with Ray Dalio, and he's discussing, it's very important. I'm just going to play a minute or two of these clips once in a while when it's really important. So listen to what Ray Dalio says, buy his books, read his books. This is really good stuff, okay?
It's like a disease that happens over and over again. There's a process. Everything that happens has a cause. And by understanding that process and cause, you know the red flags. And with those red flags, you know how to calculate whether people can pay their debts back and how the dynamic's going to work. When there's a certain rate of debt growth that is unsustainable and that there's going to be a problem paying it back, you can see that you have a problem. When you start to have a debt problem and you're close to zero interest rates, that means that the central bank, the Federal Reserve's ability to deal with that won't work. You'll hit zero. And then you enter a new world. Okay, the last time that happened was 1928 to 1929, 30, 31. That's what happened. What happened in 2007 and 9 was the exact same thing. A debt crisis, too much debt, and you hit zero interest rates and out of luck. And then what happens, there's a classic way of dealing with that, is that the central bank has got to print money and go buy financial assets. And so that's what all the entities did. And so by being able to watch it day by day as to how they went about doing that, allowed us to navigate the crisis so that we could see the rates of deterioration and then the actions taken to end that in much the same way as the Federal Reserve ended it in 1932, 1933, for the same reasons. Now that printing of money causes financial assets to go up in price, puts money into the economy, and produces the type of reaction that we've now seen in terms of that economy and those markets. Then we're at the stage of the cycle where we are now. And what happens, classically, is that those financial purchases help those who have financial assets more than they help those who don't. It causes a greater wealth gap. And very classically, that causes populism. And then you move into a situation that's very similar. So being able to see mechanically how that dynamic worked allowed us to navigate it well. The early part of the debt cycle is the great part of the debt cycle because the borrowing of money is being put into assets that are going to be able to pay back that debt and grow, and asset prices go up. Then you enter the bubble stage when everybody is extrapolating that because it happened in the past. Because those assets went up, they're going to continue to go up and they're going to continue to rise, and it pays to borrow money to do it, but they're not able to actually pay off their cash flow. The top of the cycle usually happens when the bubble exists and also the Federal Reserve or the central bank begins to tighten money to slow that bubble at the high part of the cycle. So as we take a look at that, we are approaching more the top of that cycle. I don't think we're there yet. I think we're in the seventh inning. When you have that tightening and then you have the turn down, I'll call the depression phase, that depression phase happens because you hit zero interest rates and because they're less effective in monetary policy. That's why 2008 was like it was in much the way 1930.
Okay, so I'm going to stop it right there, folks. So I believe that's a recording of Ray Dalio talking maybe last year or 2 years ago or something like that. I'll have to double check exactly when that audio is from. Someone put it together with the video. So, you know, when we're looking at that stuff, I hope you appreciate watching Ray Dalio do that, because when you're listening to that, he's describing the market cycles. He's showing the staircase type patterns that I show you on the charts. And notice how he talks about 1929. Well, previous to 1929, you had the roaring 20s where prices were going wild and inflation were going wild. And leading up to 1920, even there was a bunch of inflation, and there was post-war inflation and money printing. And, you know, then the 1929 Great Depression came. Then he talks about the 2008 financial crisis. He's highlighting a lot of the things that I've been highlighting for you. And, you know, he talks about how after a great fall comes that nice gradual stable growth he was showing, which kind of represents 2009 until 2019. And he goes, then you get the mania, everyone and your neighbor and your dog trainer and everyone's a stock trader now, right? Your cab driver's a stock trader, everyone's a stock trader. We just had that with the pandemic, okay? So when that happens, like he said, you know, we're in the seventh inning in that video. Maybe now we're already in the eighth inning or the, you know, something like that. And I think it's important to look at that and study great people like Ray Dalio and others, because even at the beginning of the pandemic, you know, myself and him and many, many, many other people were saying, let's take advantage of this inflation, but it's going to lead to eventually a recession. And that's where we probably are very close to right now. So let's go check out the chart here so I can show you what I mean here. Okay, so let's go type in SPX here. And I'm going to go share the screen. Okay, so when you're looking at this here, I'm going to go to a 1 month here. Let's go to a 1 week view. Okay, we're going to zoom out here quite a bit. Okay, so you know what, I'm going to even go 1 month view here. Let's go zoom right out here. So when we're looking at it like this, and Ray Dalio is describing these cycles here, so you have different phases in the market cycle, and you can kind of see them on the chart here. So let's look at it here. So somewhere around 1984, 85, the market started running again, and that's why we had that little 1987 dip. So what you can see here is that you have this kind of nice growth area right there after a big crash, okay? So Ray Dalio was talking about that really good time of growth after a crash. Well, that's what he's describing with that wiggly line there. Now look at the internet bubble in the 90s, huge injection, huge rally, right? Then you get a recession, okay? 2008, big injection all at once, no steady growth to start it. Then you had a recession, okay? So you can see a pattern here, and if you get good at that type of broad view, long-term measurement tool, you're going to get good at what I'm doing, and that's why I've been able to time all of the major moves of the market for quite a few years now. I mean, even with the trade war, bought right in again as soon as they took the sanctions off. And that's not something to brag about. I mean, I think that stuff's kind of easy. The same way I think that, you know, if you were to talk to me about how to rent student rentals out, I'm going to have a lot of amazing strategies on how to rent student rentals out because I've really studied it. And a lot of people wouldn't know that. So same thing with stocks, same thing with market cycles. So if we're looking at it here, we had a really nice, you know, I don't want to call it steady growth. It was still pretty crazy of a rally, but look at the trajectory, right? Kind of like that 84 to 93, 94 rally, right? You have that right there after a crash. And that's the 2008 crash over there, folks. And then you have this big hockey stick, this big parabolic rally caused by the pandemic and huge money printing, kind of like the internet bubble. Well, after that comes a recession of some sorts or some kind of a give back. And that's what Ray Dalio has been talking about. So what are they going to do here? You know, how is it going to play out? Well, over here, remember I reminded you that here's when the recession was happening already. And then 9/11 happened and it did a whole second leg down because of that, right? So right now coming up, we'll have to see, does COVID come back up in the winter with a scary strain? Does this monkeypox stuff bother us? Does Putin do something? Do we admit we're in a recession with no growth and rates are crazy? Maybe those things happen and we have a recession. What caused the big turnaround? It didn't turn around until George Bush created the housing bubble and gave everyone a home and gave everyone easy loans. We're not doing that anytime soon. It's probably a year or two away at the minimum, in my opinion. There's no way they're going to print money in 6 months unless a global epidemic or, you know, pandemic number 2 comes up or something. They're not going to just do that because that's like being 200-300 pounds overweight and going to a buffet every night again. That's not going to help you lose weight. The money printing is the problem. And so I don't expect that 2008 scenario. If anything, we are here and we still have the rest of the drop and another half a year or whatever to wait before they would even consider printing money. And they'd say, holy crap, look how much the market's falling. Let's print some money so we don't fully crash and turn it around again. I think until then, we have to rely on, oh geez, I don't even know. I don't see a scenario where there's a soft landing. I'll be honest. I can't even think of a scenario where there's a soft landing. If you stop raising the rates, the interest rates is high. And all the economists across the board, even Ben Gallagher said, you got to get 8-10% interest rates to really get inflation down to 2-3%. That's not going to happen. It's not going to happen. They're going to eat away at the inflation in chunks over the course of a few years with multiple interest rate hikes probably and some lowering along the way. So I don't know where the soft landing is. I think it's going to be a not a soft landing. Now let's scroll ahead a little more here. So now we have the 2008 crash happened over here. Let's go look at it over here. So here's your 2008 crash. Now that was a pretty sharp, quick crash, and it crashed more than people thought. And they kept saying, we're not in a recession, we're not in a recession, we're not in a recession. June, July, August, October, all of a sudden, oops, sorry, we're in a recession. And then they printed a ton of money, a crap load of money to get us out of the recession. So remember, giving out and refinancing too much money was the problem here. But what did they do? They blamed it all on the big banks and crooked, money lenders and all that stuff. That's not really what it was. The whole U.S. economy, backed by President Bush, backed the housing bubble, and then they blamed the banks for using shady practices. The government knew what was going on. If you watch The Big Short, it was all there. They just weren't looking. and it wasn't an honest process, in my opinion. So money was the problem, and then they ended up printing money again anyways to get their way out of it. So the money printing is not done. Okay, the money printing is not done, in my opinion, and in anyone smart's opinion, they're going to tell you the same thing. Warren Buffett doesn't think it's done. Kathy Wood doesn't think. No one thinks it's done. And so here's what I think's coming. We were just here in zone number one. Everyone was happy. Everything was beautiful. Everyone was refinancing, buying vehicles. Stock portfolio was all-time high. That's basically, October of 2021. Right now, we're probably somewhere around here. Okay. We're probably somewhere around here. And I think we still have another bit of a low to make somewhere later this year, potentially. Now, are they going to print money right away and just juice the markets higher like they did after 2008? Are they going to do that? And why or why not? I say no. Now, why? Because America's housing market in scenario number 2 over there was literally crashing. Everyone was losing their home. No one was buying the homes. The prices were imploding. And America's entire economy probably would have collapsed if they didn't throw a life preserver in the water. That's not the situation we're in this time. We just took on too much debt. We have to go on a money diet and we have to deal with it. I think that's really where we're at. We can't really print money that, like, we just did that like 3 or 4 times in a row. I don't think it's going to be a quick print. I don't think we're on the table with a heart attack and multiple arteries blocked. I think we just need to take a breather, and we see a little bit of plaque buildup in the arteries, but we don't need a quadruple bypass or anything like that. So I feel as though last time over here, America was going to collapse and everyone was going to start losing their homes or not being able to afford the interest rates if they kept raising the rates. So they just printed some money and they bailed out the banks, stopped them from collapsing, and stopped the whole housing market from imploding even further. I don't think that's the case anymore. I don't think they're going to have the sense of urgency. I think people have been sitting at the punch bowl for 2 years, and we were at the punch bowl before the pandemic. And I think it's time to go on a diet right now. So if you're looking at it again, I was measuring a Fibonacci retracement of just this over here. What about this? What about that? What about a Fibonacci retracement of the whole damn move? Well, let's go look here. Okay, let's go zoom in a little bit. And this is why I like to zoom out and zoom in. So let's go do the Fibonacci retracement now of the whole damn move since March 2009. Okay, so we're going to go all the way up here. Now, I'm not going to call for a 61.8% retracement in this case. Okay, so what I've learned over the years is that the smaller dips can easily be a 61.8% Fibonacci retracement. This big long-term dip is probably going to be a 38.2% Fibonacci correction. Okay, and that's because long-term, this chart is still a bull chart in a bull market. You got to remember, what view are you on? Okay, so that's why we zoom out. So if we're looking at this chart here, folks, oops, let me get rid of that here. So if we're looking at this chart here, why is Mike saying that we're in a bull market? Because if you go back, this is just going up on an angle all the time. So what direction is this market going? That's a bull market long term. Long term, Mike's bullish. I'm going to bet the markets are going higher, which doesn't mean that the stock market's amazing. What it means is the dollar sucks and you're going to keep getting less for your money. And that's why the chart always goes up, because they keep deflating the dollar, devaluing your money, your paper currency, and you have to keep giving more and more of those worthless dollars to buy stocks and cars and classic Corvettes and Wayne Gretzky rookie cards. You keep giving more and more cash for those things because they're just devaluing the dollar, and the stock market, which is measured in dollars, therefore goes up. It's pretty simple if you really look at it in that way, folks. And I try to really break it down. And when you understand the subject well enough, you can explain it in a simple way. So let's go look here. Let's zoom in again. Okay, let's go zoom in again, right? Study our history here. So if we do a 38.2% correction here, right, of the long-term move, well, where's that going to bring us? It's going to bring us in and around here, right? And doesn't that make sense when there's a huge support zone kind of over here? So I think we're going to end up going down, like maybe we're going to do a B, C, correction into the late part of 2022 or some part of 2023, and then we can rally from there. I mean, I feel as though that's probably what's going to happen. You don't have to believe me, you never know, but this looks like it's a little oversold, and corrections don't go in one chunk usually. It's 3 or 5 to the downside. I think we're going to get a relief rally. We're going to hear the R word, and then it's going to bottom. So let's keep watching that. I know I keep repeating myself, but I think this is important. And I want to show the distinction of, I'm expecting a 61.8% correction here, but I'm only expecting that to equate to a 38.2% correction of the greater move. Okay, I want to make sure that people understand that distinction. Here's the 38.2 level on the big move, and it's a staircase on the way up in a long-term bull market. That's the staircase. And then I expect it to go up for a while longer as we print more money in 2023 or 2024 and whatever. And we keep doing the same thing over and over again, right? You go on a diet, you gain the weight back. And that's, I think, the way I'm looking at it here. Or like a bodybuilder cycling on and off steroids is probably a better example, right? Now let's go zoom out over here. Okay. So where is, okay, so there's our 70s stagflation here, okay? So I'm going to show you how I'm going to define this chart. So we had this huge bull move, and then we had this choppiness sideways, okay? So this move here, let's do a Fibonacci retracement of the move that came after 1980, okay? Let's go look at the 1980 onwards market, and let's see how much of a retracement that did. I'm doing this blindly. I didn't do this before the session. I just want to do this for fun, okay? So let's go do a Fibonacci retracement. I hope you enjoy this, guys. This is stuff that I geek out on, and sometimes I like numbers more than other people, but I like this stuff. So let's go learn from this together. Let's do a Fibonacci retracement. Let's pull this in here. Let's go to the bottom right there of the stagflation, pin it in, go to the top, and touch the screen on the white part to lock it in. Now, here, if you look, I'm going to drag this over a bit. Okay. So what did it do in 1980? Now, remember, 1980, like that was a horrible correction. Interest rates went to 18%. It was crazy. And then after that, we had all this movement. So, you know, we had a drop down to the 50% retracement level happen with the internet bubble, okay? So Mike's saying it should be 38.2%. Why the heck is it 50%? What's going on here? So let's look at this and look at it with a logical mind here, because the better picture, the better story you could tell yourself with the chart, the better you're going to invest. Okay, so why did it go to the 50% retracement level when it should have probably gone to the 38.2? Well, first of all, I say 38.2, but you know, how would I have known that here in late 2001, there's the 9/11 drop? I didn't know 9/11 was going to happen. Where would it have bottomed potentially without 9/11? Well, look where it hung on. It stopped right here at the 38.2% Fibonacci level. 9/11 brought us down to the 50% Fibonacci level. So again, I can't guarantee you this. I'm just speculating, right? Maybe it would have dropped to the 50% level if there was no 9/11. I can't promise you that wouldn't have happened. But for the sake of argument, doesn't it make sense that, you know, we probably would have just gone here and gone higher, and the 9/11 drop took us that extra chunk higher, or lower rather, right? That's totally plausible, right? I mean, it went up after 9/11. So if there was no 9/11, it probably would have just stopped here and gone up, right? It's just like it did after 9/11. George Bush would have just started the housing bubble sooner without 9/11. So that's the way I'm looking at it. So basically between the 38 and the 50 is your pretty safe zone if you want to bank on something like that. So what about right now, for example? What if Vladimir Putin does something stupid and bombs France or Poland or something? Well, then you'll get the additional Vladimir Putin drop, and it might go down to the 50%. So, you know, that could happen. Otherwise, here's the 38.2% level we reached with no 9/11. Okay, just the internet bubble popping. So, you know, that's, if you look at it, you'll see that that's the case. Now, let's zoom in a little bit more here. Let me just get rid of some of these drawings here. Now, let me zoom in a little more here. So what about this last move here, the actual internet bubble, right? If the overall great move from 1980 to 2000 was a 38.2% greater correction, well, Mike says it's supposed to be around 61.8% more likely. on that last really big inflation push leading into the recession. Well, that's the internet bubble. So here's 1994, around 94, 95. I know where I lived, everyone started getting the internet, computers, Pentium chips, all that stuff. I had a Pentium 75, I remember. So let me, okay, I think we got an overlap here. Okay, let's get the drawing tool out here. So the 61.8% Fibonacci correction right there. Okay, so we ended up hitting this 61.8 Fibonacci correction here, and you could visually see it's about 61.8%. So you'll see why I'm teaching this to you guys, because when you see the really long term zoomed out, let me get rid of some of these Fibonacci's here. Okay, so when you're zooming out here and you're seeing this stuff here, folks, what I'm trying to point out is these big moves tend to correct about 38.2%, and then they go up again long term. Okay, so here, right, 38.2%, and then it went up in part two again long term. Well, I think part three is coming. Okay, I think part three is coming, and we are right now in one of these phases. Okay, right now we're in one of those phases. Part three is coming. I think it's part three is coming, and if I can move this over a little bit. Okay, so essentially, the way I'm looking at it is I think number three is still coming. Notice at the bottom of your chart, you're seeing 2024, 2025, all that stuff kind of denoted at the bottom of your chart there. I mean, I still think we're going to have another big bull run somewhere between 2023 and 2030, and then we'll have another recession, along the way, maybe two, stagflation potentially, right? Don't never forget here, look at this, internet bubble, crash, 2008 crash. Look at that choppiness, that big W pattern over there. It went like this. Okay, well, what if right now we do that, right? Up, down, up, down, up, down, and we go up, later in the future in 5 years. It doesn't have to just be a straight rocker ride. We just did the straight rocker ride with number two. The rocket ride number one was the internet bubble that popped it. Rocket ride number two was the pandemic bubble that popped it. Now we'll go on another rocket ride starting in a year or two from now, probably. And then that one will get popped by something else, That's the way I'm looking at it, is just, this is a staircase, stairway to heaven here. This is just going to keep doing that. And Ray Dalio talks about that in his videos. So is number three coming anytime soon? I think, heck no. Heck no, it's not coming. We just finished number two, right? After the keg party comes the hangover. We're in the hangover phase, and the hangover could last 6, 12, 18 months. Who knows? So I'd be careful. We're about 6 months into this hangover, and I think we're just getting started. So, hopefully you appreciate that long-term view. I love doing that stuff, and hopefully you understand the difference between a 38.2% and a 61.8% Fibonacci retracement, and when they might be less or more likely. Okay, that's a really important one, and I hope you guys appreciated that. If you have any questions on that, let me know. That was kind of a nice summary I did for you guys, where I really tied everything together and went a little deeper there for you. Okay, Julio saying cool stuff, Mike. Julio, did you like that? Because you're here every week, right? But even that was probably kind of new to you, the way I tied that together, right? And the greater corrections, 61.8% is not actually more than 38.2%, because the small move of the pandemic falls 61.8%. But the huge move since 2009 falls 38.2%. 38.2% is probably the bigger number, right? Percentages lie. I have my degrees in statistics. I've got an advanced specification of statistics in my degree. It's an optical illusion sometimes, and you can use statistics and numbers and percentages to trick people. And so this recent correction might fall 61.8%, but the correction from 2009 until now will fall 38.2%, and that scares me more than the 61.8%. So, when we're looking at it from that way, we're going to be more prepared, more intelligent, more capable when we're investing. Okay. So let's go dive back in here. Okay, I've got this iPad kind of figured out now, so I'm going to do it this way. And I like the video with the phone. I've got able to do the chatting and everything at the same time, so it's real good. Okay, so let's keep going here. So Tesla, one of Julio's favorite stocks, one of my favorite stocks. Kathy Wood loves this stock. So they delivered 254,695, so about 255,000 cars in the second quarter, just shy of their estimates. Okay, just shy of their estimates. The deliveries were 201,000. So they almost met their expectations basically, and that's pretty good. So right, it says here they fell just shy of analyst expectations. Okay, just shy. They basically met the expectations. So they were expecting 256,000. They got to about 255,000. That's close enough. But during a recession or a potential recession, they're talking about a fictitious soft landing, in my opinion. Let's go check out the Dow Jones just for fun. Okay, so you could see that one as well. Same type of a thing here. So we're going to probably fall quite a bit lower, and you can already see where the likely support zone is, and it's a kind of in there probably. It's a likely support zone, right? Where we at here, probably 27,000 ish, give or take, and maybe it'll go a little lower if it gets real nasty. So, it's one of those things. Tesla. Actually, let's check the Tesla chart out. I'm still not buying it. If you're buying it in chunks, that's cool. I just hope you've been buying lightly, and maybe you'll get a turnaround soon and actually make some money. But if you look at the monthly chart, you'll see why I don't really love Tesla or any chart right now. I mean, it's just a downtrend. You could be happy that it maybe started bouncing a little bit recently, but that's all I'm seeing is a downtrend, and I don't really want to be a part of that downtrend. So if I'm looking at it, let's zoom out on Tesla here. Okay. So look at that move it just made right there. I think we have to do a 61.8% correction of that. So not to scare anyone, I think Julio's probably crying over there, 61.8%. No, I'm sure you got in some of them really cheap and you're probably doing okay. So if you look at this here, we already did a 50% correction. Okay. So, what does Mike think's probably going to happen? I think we're going to get an A, B, C correction like that of some sorts. Okay. So where is your 61.8% landing zone? It's around 450 to 500. Okay. Let's call it 500. I really think Tesla can go back towards 500. And I mean, when did it get onto the S&P? Right. Oops. Sorry, guys. Right here. Okay. That X I just drew right there, that's when they got in the S&P. Doesn't it make sense that we would go up, retest, and rally from there and show support from the decision of going on the S&P? I think that's exactly what's going to happen. And just because we blew past it and so Tesla's a great company doesn't mean we're not going to retest that yet. I think we're still going to retest that. We're going to do a 61.8% total correction. And then this is going to go to like $2,000. It's just because I think it's going to go down more short term during a recession. That's not really much of a bold call, in my opinion. Sorry, guys, I just got to share the screen here. I was drawing here without sharing. There we go. My apologies. So when you're looking at it here, I was just drawing on the chart, so I'll do it again here. Tesla right now, in order to do a 61.8 Fibonacci correction of the pandemic move here, right now we're only at the 50% level. I think we might get a bounce soon and then do an ABC type correction where we land here around $500, 450, 500 maybe. And that's probably in and around where it's going to land. And then long term, I mean, you might say, Mike, do you hate Tesla? Why are you all bearish on Tesla? I'm really not, right? Mike was saying, buy Tesla. Now Mike is saying sell Tesla recently. And guess what? I'm going to say buy it again sometime later this year or early next year, because I think it's going to go up to $2,000. I think this is a staircase pattern of the upside, and we are currently in this ABC type pattern to the downside. So, it's one of those things that, you can't just be a cheerleader for things all the time. I don't think, if you're going to be honest about shorter term movements. If you're a 10-year person, yeah, I guess you just hold your Tesla, right? And you add during the crashes when they happen. But right now, I think we're in the middle of an A, B, C type correction. And then we'll have a greater move up later that I'll be a part of. And it's probably going to go all the way down to 2025 or 2030 range, where you can just kind of hang on to that company and some other companies. And I think we're going to have more inflation, more money printing, and we're going to have some stagflation in the market, but we're still going to have some rallies to take advantage of. Okay. So let's keep watching Tesla. It's going to be on my radar. And there's the Tesla article in case you didn't see it on the screen earlier there. Tesla's delivery is about 255,000. They were trying to get 256,000. So we're going to keep them on our watch list. The fear and greed index, in case you haven't checked it, it's still really extremely fearful in that range of 24. Last year it was last week it was fearful. Now it's extremely fearful. I think people don't know what to think and they're easily swayed. At the end of the day, we've been in the fear zone for a while and we're not going to get out of there until we see inflation come down, I think. So what do we do to deal with this stuff? People say, you buy gold, you buy Bitcoin, you do all this stuff. Bitcoin posts its worst quarter in more than a decade. That's not going to save you. Gold and silver have been tanking like crazy along with the market. That's not going to save you during a crash. If you took my course, you know that I taught you guys that stuff doesn't save you during a crash. And it's one of those things that it can save you after a crash, because after a crash you get more inflation, right? After the keg party you get the hangover, but when the hangover is done, there's another keg party. So that's kind of the thing I'm looking at. The next keg party is going to make Bitcoin and stocks go up again, right? They're going to probably print money again, lower interest rates, and do a stagflation type thing. So worst quarter in more than a decade, is that a surprise to us? It's not. Anyone who trained with me, I advise people in 2020 and 2021 to buy Bitcoin, stocks, rookie cards, whatever you want to buy. And I advised that I'd probably sell my cryptos in late 2021 whenever there was a catalyst and the cycle of the Bitcoin halving was coming to a completion. So that's why I sold earlier this year. And now I'm still waiting. I think it's still going to go to at least 15,000, maybe even 10, 12,000. We'll see how bad the recession gets. So I wanted to go into another little topic here now. Sometimes I'll go into some more fun and interesting things. And we're always I've been talking about inflation for like 2 years, way before it was a hot topic and a popular word on TV. You'll notice in my podcasts and in many of my training sessions, I'll bring out my $100 trillion bill here. So I'm a trillionaire, technically, in Zimbabwe. And that basically will buy me nothing. It's not even real currency. This is actually probably worth like $80 or $100. I bought this for $30. I'm into collectibles. I actually bought this for fun. It's a story piece, a conversation piece, an icebreaker. I've given many to friends of mine that I know who would appreciate them. I also bought it as a collector. They're rare. I think I paid 20, $30 and they're worth 80 or 100 now. I'm going to keep that. One day that'll probably be worth $1,000. And, I want to teach you guys a little more again about why do I like Bitcoin? Why do I care so much about these things? It's because I started off as a gold and silver investor, and I read Currency Wars by James Rickards. I read The Warren Buffett Way. I studied Ray Dalio. I did all these things. I became a gold and a silver investor way back in 2010, after the crash of 2008 happened. And I studied and I studied and I studied, and I made myself figure out what happened, why, where's it going from here, figuring out all this stuff I've been teaching you. And I'm trying to save you time by teaching you what I've learned, and you can take it with you in the future. And when I learned guitar on my own, I remember I learned a bunch of songs and screwed up and it was difficult and I used the wrong fingers. I figured out how to use different fingers to use it more efficiently. And when my roommate learned the same songs, I just taught him the quick way. And that's what I'm trying to do here with you when I'm doing the weekly training session. So, this is a solid 10-ounce piece of silver. I own gold and silver and stuff like that. I'll show you some other stuff I got here. So these are tubes of coins. Okay. And you can buy gold and silver coins in tubes of 25 or 20. They come. These are really heavy. You could do some bicep curls with these. They're pretty heavy. So I'll show you the Canadian maples here. So this is a 2011 series. Okay. So these are all pure silver coins. Okay. In my hands here. These are all shiny, shiny, shiny silver coins here. And these ones have the maple on them. Okay. So that's the Canadian maple leaf. It's a 2011 series. I think they made 11 or 12 million of these, folks. And it's got the queen on the other side, and it's solid. This is solid, heavy stuff. Okay. So I've got a whole tube full of these. And, this is something that they're heavy, but they're compact, and you can store them pretty easily in a safe deposit box or whatever you want to do. And you don't have to do this. I'll show you why I did this. And I am a collector of things as well, so I'm comfortable with it. But, if a really worst case scenario happened, your physical silver and gold could go up a lot. So maybe in 2 years or 20 years might happen. And I'll show you from a collectible perspective how I've made even more money on it. So this is my blue cap tube. That's the moose, okay, the Canadian moose. So this one here has got a wildlife series. You can see the moose with the antlers there on the front. And so the Canadian Wildlife Series here, let me get you a better one here. So it's got the moose there on the front. So there's only 1 million of those. Okay. So I own, I don't know how many tubes, 3 or 4 tubes of just the moose. And these ones here, they're really collectible. There's only 1 million of these. And these ones here, I believe there's 12 million, I think, or 10 million, something like that. So this is 1/12 as, 12 times as rare. And it's got the wildlife moose on it. Now let's go do a little, let's have Mike show you some stuff on combining my collectible skills with gold and silver. Okay. So why do I have this moose series? Why did I buy these? And why do I have the maples? And why does Mike, does he have dried food in his basement? Why does he have gold and silver around? Well, I'll show you why. So I don't have a bomb shelter or anything, so that's not why. So I'm gonna go take you on eBay. Okay, as you know, I do the Connor McDavid rookie cards. I've got autographs. I've got a ridiculous amount of high quality collectibles. And when you're going and you're looking for collectibles, folks, there's a skill set involved in it. I have a pretty high skill set at this stuff. So, if you want to go here and you want to look up an obscure series that wasn't that popular, like maybe, you could look up RoboCop. If you wanted to do something like that, RoboCops, or all kinds of RoboCop toys, they're worth 30, 40 bucks, 20 bucks. You can get them real easy here, folks. Look, 50 bucks. You can buy some of these. Now, if you wanted to, I could show you how to get the rare ones. I know the rare ones, so you have to do a lot of research to find this out. But I used to own this when I was a kid. I was obsessed with this movie. These ones here, this one's opened and it's 125 bucks. Okay. Now on the left side here, I'm going to teach you some eBay skills here. Go to click where it says sold items. I clicked the wrong one. My apologies. I clicked completed items, just sold items. Okay. So sold items. And then I'm going to go here on the drop down menu and I'm going to go highest shipping, highest sold first. So some of these here. Okay. There you go. $205, $150. So some of these are worth $150, $200, $300 if you have it. Like I have 2 or 3 of these, okay? Because I bought them a while ago. I paid 30 bucks each, $30 I paid, and they're now worth 150 or 200 US, okay? Sometimes you get a deal and people bid 130, 150, but if you hold out and you do a buy it now price and you don't put it to auction, you'll get 150, 200 all day, and I paid 30, okay? I flipped a bunch of these at 120, 100. I remember buying a whole box of them from a wholesaler. Now, why are we talking about RoboCop? I'm not recommending that you buy RoboCop, but what I'm saying is that you can pick good quality stuff, and that stuff will probably never go down in value. So if you want to type in Mego Spider-Man, the original Spider-Man toys when he became a big deal, let's go here. Okay, there's the old, look, a bunch of loose ones are 225 bucks. Could you imagine those in the box? They'd probably be like $3,000 or $5,000. So let's go on the left side here. These are sold items now. Okay. So these ones are just in the box here. Okay. So now these might not be the original ones. These are 1977. There might be some earlier ones that you can get in the box and they're even more valuable. So I have some of these loose and you get 100 or 100 more than that, 150, 200 bucks in the box for these ones. There's certain stuff that'll go, a Beatles White Album, stuff like that. Well, you can also look at, Wayne Gretzky rookie card, right? Michael Jordan rookie cards, silver coins. Let's type in Canada, silver, maple. $2011. Okay, so those are the ones I showed you in the yellow tube. Okay, so here's a roll of them, 25 maples. So my one tube, you can get $850 American here. There was a recent sale of $850 for a tube of them, like I just showed you. Okay, 3 of them, so 30. You're gonna get about 35, 40 bucks each on the low end, it seems like here. Okay, 2 of them sold for 72, right? So 35, 40 bucks for 2 of them, 850 bucks for a tube. I think I paid $23 for them back when silver was whatever value it was, 20 bucks, 22 bucks again, back in similar value to now. But now instead of it only being worth that 23 or 25 bucks I paid, I can actually get about 40 bucks. So, hopefully you realize that I'm up somewhere between 50 and 100% on my silver coins, even though the price of silver is basically the same. And the reason is there's only 12 million of these and they're sought after in the aftermarket. So I'm actually up probably 75% on my coins, even though if you own actual gold and silver, you're not up at all. You're actually even to the same price it was at in 2011, pretty much right now. But I am up on my silver coins by an additional, let's call it 50 to 75%, because I invested in it like a collectible, like a rookie card, like a toy that's rare, like an album record that's rare. These are collectible. Okay. So that's why I'm trying to teach you that. So let's go look at the moose. Silver moose, 2011. Oh, 2012, my apologies. I think that came out at the beginning of 2012. Okay. So these, you can see some of them sold for 35 bucks. This single one just sold here for 60 bucks in a little capsule. You got the bear and the moose here sold for 35, 40 bucks each. Here's a single moose that sold for 54 bucks, 57 bucks, 53, 53, 50, 45, 45 with no case, 45 with no case. I'm going to call it 40 to 50 bucks, guys. The other one was 35 to 40. This was 40 to 50. You get an extra bump because it's a collectible, and there are 1 million of these instead of 12 million. It's decimal 9999 fine silver. It's almost 100% fine silver. And so let's call it 45 bucks and the other one's 35 bucks. I probably paid the equivalent of probably 27 or 28 for these ones. And they're worth, again, 50 or 75% more. Okay. So gold is at the same, gold and silver are at the same price, but Mike's coins are up 50 or 75% because he treated them like a Wayne Gretzky rookie card. So I just wanted to make sure I showed you that. And, you know, even my silver bars and my other gold and silver things that aren't a collectible coin, they didn't go up as much. My gold chain on my neck didn't go up like this at all, right? It's the same price pretty much. So if you're studying and doing things properly and you know how to use some basic eBay tools and judge rarities and collectibles and use the same kind of tools I use to buy the Connor McDavid rookie cards and buy my, you know, even the RoboCop toys that I flipped and stuff, that's because I have a personal interest in it. But maybe you want the Beatles album, maybe you want I have a Mike Tyson signed boxing glove. You could put it on display in your home and it'll go up in value probably as time passes, but it could be a gold or a silver coin. Again, these here, you know, I have a whole bunch of these and safe deposit box, and you can store these away. And you might say, you know, you don't have to be a bomb shelter person to think that there's going to be some crazy thing happening, but look how much these went up in value compared to owning just regular gold and silver, right? These are up 50 or 75% when the gold price is flat because I invested into collectibles that happen to be made out of silver and gold. So I just wanted to do that as a change of perspective and to hopefully make you realize that, hey, you don't have to be a bomb shelter, dried food, tinfoil hat person to believe in physical silver or physical gold. And look at the way I did it, right? Look at the rarity factor. And I think I paid maybe a $2 premium or $1.75 premium above the real price of silver and gold when I bought these type of things. But look at the money I made now, right? They went, I'll pay a premium of a few percent to then make 50 or 100 or hundreds of percent. If I just keep these, they're going to be worth more and more long-term, folks. I have no different than my Zimbabwe currency, right? This is just going to go up. They're not making any more of these. Okay. They're not making any more Beatles white albums. They're not making any more Connor McDavid rookie cards. They're not making any more Moose coins. There's only 1 million of the Moose. I got them right here. So, you know, if you want the Moose coin, if you want the Beatles album, if you care about those things, you have to buy them from someone like me or you. So if you are going to be one of those people, you know, like I said, I have no doubt this will be worth $100 or $500 one day. And I have no doubt that these will be worth $100 or $500 each one day, depending on how long I hold them for and what happens. That's the way I'm looking at this stuff. And so I wanted to make sure that we went over that tonight and you got a little bit of a different perspective today. If you ever have any questions on that stuff, again, even, you know, physical, you can buy gold and silver bars, 10 ounces each, even heavier, bigger ones. I have a safety deposit box. You can do it that way. And I think, you know, you should talk to your own financial advisor and do whatever you want, but look at what's happened for me, right? Look how it's benefited me with these Moose and these silver coins. When I call my coin dealer and I check in with them on the prices and stuff, He begs me to sell my coins, and I say, no, thank you. I'm going to hold the coins long term. He's begging me for the coins because he said, I can't find them. You can't get them anymore. They're so rare. They're so hard to come by. This is a guy who's been in the industry for 20 or 30 years. I am not selling those. He said he can move those in 2 seconds. He'd have a buyer like that. And online, they sell for 800, $1,000 a tube easily. So I'm going to keep holding those. I'm going to hold my Connor McDavid rookie. I'm going to hold, I went through all kinds of autographs I have today. Sylvester Stallone. I have, Michael Jordan, Bobby Orr, Muhammad Ali. I'm keeping all those. And if I'm selling anything, it's a lesser product, something I don't care about as much, something that I feel won't last the test of time. And that's the same way we treat our stocks, right? We hold the winners, we hold the Apples, the Microsoft, and the other ones, maybe you play around with them, maybe you get rid of them along the way, like a Space Virgin Galactic or something else. So hopefully you appreciated tonight's lesson. I went a little bit off the beaten path. I showed you the Fibonacci retracements and the differences between the pandemic correction, which might be a larger percentage, but a smaller number, and the total market cycle correction, which will be a smaller percentage, but probably a bigger number. And just relating everything back to, inflation. And why do we buy stocks? Why does Mike have heavy dumbbells made out of moose coins here? Why are we doing these things? It's because long term, I know there's going to be more inflation. And right now, if we have a crash, I want to buy someone else's moose coins at a discount for $600 a tube or $500 a tube. Give me your moose. I will buy them for $500 a tube, no problem, because I think they're going to be 1,000 to 2,000 range in the next maybe 10 years. So, I want to buy that stuff from other people. I want to buy Apple shares from someone else at $100. I want to buy the moose from someone else at $500. I want to buy whatever it is. I want to buy it from someone who's panicking, buy when others are greedy, sell when others are greedy, buy when they're fearful. So someone's going to give me a tube of moose coins, maybe for $500-600, because they need that $500-600. They can't pay their mortgage. They lost their money in the stock market. They lost their job. And I'm not trying to take advantage of anyone. I'm just saying it'll be listed on eBay, or I'll have the opportunity to just go buy silver and Apple and Microsoft in the market. But just remember, you're probably buying those shares from someone else that just lost a bunch of money in some cases. It's just the way it works. It's not, you shouldn't think about it as pillaging on someone else. It's just the way the market works, right? You're getting, there's always a yin and a yang to the market. So those who are prepared can take advantage of it, and those who aren't prepared will be at the mercy of the market. Maybe you're going to be the one selling me or someone else the $900 tube for $500 or $600 because you need it. What if you have a rookie card? What if you want to sell a rookie card in a pinch, quick? Well, it's a recession. Money's tight. Interest rates are high. I'm going to offer you way less on your card because money's tight. And during a booming bull market where money's falling out of my hat, my pants everywhere because there's money coming to everyone for free, I'm going to throw it around and give you extra money for the rookie card. That's just the way it works. And I think that's where we're coming towards now. I don't think we're there yet. You're not getting much of a deal in the housing market. You're getting a little bit of a deal in the stock market, which is normal. But I think the bigger deal is still to be had. And we're in that 7th to 9th inning range, with the finale probably being in the fall or the winter. So let's stay tuned on this stuff, guys. Hopefully you appreciated this session. I went a little above and beyond, and I'm trying to do some unique stuff so that we're not just always doing the same thing every week. We snuck in the news, we snuck in everything else. And we'll make sure this gets posted for everyone. Thanks, Julio, for tuning in. For everyone else, you'll catch this on the posted recording, and we'll see you back here next week for another weekly training session. Take care, guys.